the month of January. So the December 31st balance is beginning inventory, not ending inventory. So potentially a little bit, you know, tricky by student standards, but you just read a little bit and there it goes. So this is the beginning balance, 15,000. Mr. Kanoy, did I just see you yawning? No. Yes, I did. I'll actually, since I've actually conversed with Mr. Kanoy, you know, like 5 times already, before his card came out, I'll actually give. I mean, you have though. You helped me out with the T accounts down the left side. Do you recall that?
I do.
Okay. Do you remember what they are?
Yep, direct materials, direct labor, manufacturing.
But you did have to peek at the first one. Mr. King, because his eyes moved. He went and he had to go peek. Mr. King, another number. The next number, please.
We got beginning finished goods of 20,000.
Beginning finished goods of 20,000 what? Thank you. Heidi, what's the next number? Oh, you skipped one. Yes, you did. Heidi, can you help him out with the number he skipped? He wanted to go for the, I know him, he wanted to go for the really easy ones. Yes. 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 Debit side, credit side? One of the two. It's on one of the two. Where's in to affect? Huh? Debit. Of how much? $57,000. Very good. How are you doing? Okay. Yes, sir.
Why did that end date? Because it says for January.
What kind of an account, Mr. Kanoy? What kind of an account is manufacturing overhead? Revenue, expense, asset, liability, owner's equity. Expense account. Do expense accounts have beginning and ending balances? Well, that is the, now you'll remember, hopefully. Okay, so that must refer to the activity in the account rather than the balance, just because of what kind of an account it is. Yes, ma'am.
Okay, my question would be, are we still doing like the budgeted overhead and everything like that?
What do you mean?
Like, because we had it set up where it was, oh, okay, no, actual was the debit side and applied was on the credit
Yes,
side.
we're still going to do that.
Okay.
Awesome. I'm glad you remembered. She remembers from last class period. I mean, most of you have slept several times since then and may not remember. And so, I'm sorry? Not Laura. Cody, what's the next number? Number 1, I guess, huh? Are we all the way to number 1, Cody? Yeah. Awesome. Number 1, the overhead is applied. Did you hear her up here? I hope you didn't hear her up here. She might have helped you out. The overhead is applied using a budgeted rate that is set every December by forecasting the following year's overhead and relating it to forecast direct labor costs. The budget for 1992 called for $400,000 of direct labor and $600,000 of factory overhead. What are we going to do with that information, you think? What's the fourth word in that sentence? Cody? Cody, what is the fourth word in that sentence? The first sentence. The overhead is applied. Do you know a formula for applied overhead that we got last class period? Aubrey, do you?
Are we looking for the predetermined overhead rate, or are we looking for the just applied manufacturing?
Which one do you want to give me?
The predetermined overhead rate.
Why do you want to give me that one? Oh, PDOR equals, Cody, keep looking. She doesn't know the applied overhead one, so you can give me the applied overhead one. And Aubrey can give me, I thought you knew it.
I do, I was looking for the applied one.
It should be on the same page.
Well, I'm saying I knew that one.
Okay, okay, okay. You do? What is it?
Estimated manufacturing overhead divided by estimated activity.
Okay. Cody, you got something for me? Beautiful. Okay? Absolutely gorgeous. Brandon, you probably don't think that's beautiful either, do you? Accounting is not fun, and formulas are not beautiful. Mr. Musgrave, Mr. Musgrave, how are you, sir? Awesome. So what information can we get out of number one that we can perhaps put into one of these formulas? You missed last class period? Yes, but you learned these exact same formulas last semester. In Principles of Managerial Accounting. Yes, sir.
From what I can see, in my corner,
Have you not watched the video? But our wonderful videographer puts them up very quickly. Like today's will be up tomorrow, probably. So it's there, you can watch it. Okay, just saying. Mr. Newland, can you help him out? Were you here last class period?
I was not. I had my interview thing.
Oh, that's right, that's right. Did you get a job? Cool, very good, congrats. Pamela, can you help out these poor gentlemen?
Go though.
Can you give it a go?
Well, I mean, just that it's going to be 600 estimated manufacturing overhead, right?
Yes, I do believe 600.
$600,000, sorry.
$600,000. Beautiful. What's going to go underneath, Pamela? Help out these poor gentlemen, neither of whom wanted to come to class on Thursday. Estimated activity. Now, the first sentence is very important to us here. It says, overhead is applied using a budgeted rate that is set every December by forecasting the following year's overhead, which we've not done. Forecasted overhead is another word we could use for estimated overhead. And then they're relating it to what? Direct labor costs. Okay? So that's a very important piece of information for us. Direct labor cost is our activity. That's a very important piece of information for us. And so what is estimated direct labor cost, Pamela? I think $400,000. And what's that equal? Christy, have you got it calculated already? She doesn't even have a calculator out yet. Do you have it calculated? What is it? 1.5. 1.5. Angie, 1.5 what?
Direct labor, or dollars per direct labor hour.
Incorrect.
Or, oh, well, it's just gonna be dollars per direct labor cost.
Yeah, it's dollars. It's $1.50, $1.5 or $1.50 for every dollar of direct labor cost, but not hours. It's not hours, but dollars. So it's $1.50 per direct labor dollar. It also equals 150% of direct labor dollars in total. Now those two aren't quite the same thing.